you close or you could process transactions in 2015, you will have to close 2013 if you have not already. So if you've already closed that fiscal year, don't worry about this. You should go into the accounting period screen and see the 2015 fiscal year open. This is assuming that you're on a calendar accounting year, which most of our clients seem to be. Now, when you close the 2013 fiscal year, you'll open up the 2015 year automatically. And within SedonaOffice, as you know, we maintain 2 fiscal years open at any one time. Now, for each accounting period, it will have a status, and it's one of 4 statuses. It's either going to say future, closed, open, or reopened. Now, future is the same as a closed status, meaning that closes that account, that accounting period's closed, and no financial transactions can be made within that period by any user. Now, one of the things that we see in our support department sees quite a bit is companies that will have many, many accounting periods open at once. So if you don't, please get into the habit of closing your accounting periods that are not in use. Remember, if you maintain an accounting period open, a user could create a general ledger transaction within that accounting period, which would change your financial statements. So it's a good practice to close your accounting periods when not in use. So a lot of times you might have the, as you transition from one month to the other next month, there might be a period of time when you might have 2 accounting periods open, but try to close that the older accounting period as soon as possible. And that leads to the other status, and that's called the reopen. The reopen status is a very powerful status, and only a user in your user setup who has the permission to create general ledger transactions in a reopen period will be able to do that. So if you ever have to go back and make an adjusting entry in a previous period, again, this is a perfect example for year-end journal entries. So you might be months into the, wait, Rebecca's walking in here. This? It is hidden. Okay. So this, a reopen period means that you can, only a user, and I call it the super user access, only a user who has that access privileges, such as a controller, would be able to make a journal entry within that period. And as I was saying, it's a perfect use, like, so when you look at next year and you get into March, April, or May of 2015, and you might need to make a year-end journal entry to the previous fiscal year, when you reopen that period, don't use the status of open, use the status of reopen. And be sure only a controller should have access to being able to make adjusting entries using that status. It's a great control mechanism, and it's a great tool to make sure nobody's changing any GL transactions in a period that they shouldn't be. So make that, that's a really good habit to get into if you're not doing it already, of making sure that you're closing your accounting periods. And one last thing about the accounting periods. Only a controller should have access privileges to open and close the accounting periods. You do not want to give this procedure or this option to users, because they could theoretically then go in, change the status, make a change, and then change the status. And maybe another thing to think about as from a year-end perspective, it might be a good time to go back and to review all of your user security permissions. You know, especially if you've been using SedonaOffice for quite a bit of time, sometimes those permissions become much greater than they need to be, or maybe there's features out there that some users don't have that they should have. So it's a good time to maybe make that as one of the cleanup agendas, maybe if you get slow during the holiday periods to just review all the user security settings. Okay, so let's move on. So what I want to talk about next is the SedonaOffice GL account structure. And most people should be familiar with this, but it's always good to review this. So this is a little diagram that talks about the GL account structure. And when you think of a GL account, look at the bottom of the screen. You have 3 segments to every GL transaction. You have the GL account number, you have a branch, and you have a category. Now, categories will only affect your income and expense GL transactions. They're really not for the balance sheet entries, anything that's going to affect an asset, liability, or equity account. Now, how do these transactions relate to customers? So when you think about it, let's go over to a customer for a moment. When you think of a customer in SedonaOffice, we have the customer, we have the site, we have systems. And then when we're talking about how transactions get affected, it's at the site level. The site level has a branch assigned to it. So a customer could have more than one site, and each site could be assigned to different branches. Any transactions at that site level will follow the branch of that site. So when you post it, the income and income expenses, really what's going to contain the GL account, that's where you're going to pick up the GL account for that transaction, and the branch is really coming in from a site level. As well as you can have a category. The category could come in actually from multiple sources. It could come in from a job, as you could look at it from this example. It could be coming in from the service ticket, if it's a service ticket. If it's a recurring service, it could be coming in directly from the invoice item code itself. And it's your invoice item code that actually has the GL account set up to it. So this is something, again, very good to review. If you are going to the users conference, we do have some classes that go through this in great detail. But when we start talking about the GL financial reporting, it's very important to understand how the makeup and how the transactions are all going to post to the general ledger. So keep in mind that the branch is always coming from that site level of that customer. Okay, so let's move on. If you have any questions, just fill those out and we'll come back to those. Now, something that's very important within the GL structure within SedonaOffice is many of the GL accounts are what I call control accounts. They balance to a subsidiary ledger. So for example, let's take the accounts receivable account. There's a general ledger account for accounts receivable, but you also have an aging report. And your aging is really all of your open invoices. Well, your open invoices should balance to your accounts receivable. Just likewise, your open bills from your vendors should balance to your accounts payable. There's an unapplied to cash GL account. Your unapplied to cash should balance to all of the open unapplied cash items that are sitting on your customer's accounts. Same things with unapplied credits, advanced deposits. Also, there's the inventory account. Inventory is your inventory asset. Well, your stock status report should balance to your inventory. Same thing with your deferred revenue. All your outstanding deferred revenue should balance to your deferred revenue. There's one, and the main reason when we go in and we find that these accounts are out of balance with their subsidiary ledgers is because users have created journal entries to these accounts. So as a rule of thumb, never create a journal entry to any of the control accounts within SedonaOffice, or you're going to have a real tough time balancing those to that. Now, one way to find that is by just going into the GL register under the general ledger, pulling up the account and searching based upon a journal. And I'll do that in just a moment just to show you how easy it is to do that, to find those transactions if it does occur. So don't post to any of these, I know our trainers have a document. I'm going to ask Rebecca to make sure that gets posted on our website that has a listing of every GL account that you should never post a GL transaction to. Okay.
Michael, there's two questions for you.
Okay, go ahead.
The first one is there a report you can run that gives you income for one category, not all?
Okay, I'm going to talk about that and answer that in just a moment. But let's, I'm going to move on because I'm going to talk about that. I wrote it down, but I'm going to talk about that and answer it when we talk about the financial statements. So I'm going to come back to that one in just a moment. What's the next question?
The next one is, what if these accounts are out of balance and no one has journal entries directly to them?
Okay, that's a very good question. So if the account is out of balance and there's no journal entries to it, we need to do some forensic work with you to try to figure out why. And then we're going to have to work with you to get them back in balance. So if you have that situation, contact our support department and let them know about that. And then it's probably going to be escalated to level 2 where Jim or Don or even myself might get involved with it. But we'll have to do some forensic work to determine what's going on there and to see why that's the case. And that really leads to this next slide that I'm going to show you. And this is one of the reports that's built into SedonaOffice. It's the AR audit report. And I suggest when you close a fiscal month, this should be the first report that I would run. There's other balancing reports you should run also. But this report, at a simple glance, will tell you if the AR is in balance or not. And you'll notice on the bottom there is a variance. That variance should be 0 at all times, because this is balancing your general ledger beginning balance to your general ledger ending balance based upon all the transactions that have affected it, meaning new invoices, payments applied to accounts receivable, unapplied to cash, advanced deposits, and so on. The nice thing about this report is you can also run a detail of all the transactions for all of this. Now, if you have to go through a audited or a reviewed financial statements with your CPA at the end of the year, this is the first report you want to point out to them. There's never been an audit or there's never been a reviewed financial statements where the auditors don't come in and balance your accounts receivable. This report does it for you and proves to them that it's in balance, and it gives them all of the detail for that as well. So they can go do that. Then they can go in and improve the numbers, contact your customers, do what they need to do for the audit. But this is a great report. If you see a variance on this report, the first thing to do, check each one of the GL accounts, accounts receivable, unapplied cash, unapplied credits, advanced deposits, and determine did someone create a journal entry to those. Because if any of those accounts have a journal entry posted to them, chances are you will have a variance in this report. If those do not have a journal entry and you still have a variance, you need to contact support. We will then take a look and determine what's going on. And maybe something happened and there was a hiccup or something caused the transaction to be out of balance, but we need to fix that right away. Make it easier for us to support you. We have clients who don't run this all year long and have a problem in January or February, and they don't let us know until February, March of the following year when their auditors or when somebody comes in to look at their business for the previous year. So be on top of it. It will let us be on top of it as well and help support you better. But again, this is probably one of the key reports to run. Now, on our website also, under the documents and reference guides, if you don't already have it, there's a great reference guide out there on the monthly closing reports. This is one of them that's in there, but it just talks about different reports you can run on a monthly basis on what you can do to close your books. Okay, So let's talk about the financial reporting for just a moment. Financial reporting is one of the most tricky parts of creating an application like SedonaOffice. And simply, it's because we have a large variety of customers and a huge variety of financial statements and reporting requirements that are necessary. So what we have done is we have created 3 different financial reporting options that you can use for SedonaOffice. The first 2, the nice thing is they're no charge. They're included with the software, and they're both excellent and work very well. The first one is the SedonaOffice built-in reports. These are your basic financial statements. So I'm going to come back to that other question in just a moment. So the second option is what's called our Excel reporting tool. And what we have done, and it's documented on our website, and again, if you have any questions, please contact us. We'll walk you through how to set this up, and it's really not that difficult. And I'm going to show you this in just a moment, the Excel tool for this. But we have created, using Microsoft Excel and a mapping tool, where you can design and lay out any type of financial statement, or virtually any kind, using Microsoft Excel. And the nice thing is you build the Excel template one time, and then literally every month you just refresh your data, and then you have your financial reports. You could even do your budgeting using that tool. Again, it's really just a matter of your time and your laying out whatever types of financial reports you want with this. Now, going back to the question that Rebecca asked just a moment before, how can we create an income statement for just one category? Well, the SedonaOffice built-in reports does not do that. So if you were going to create that, you would need to use the Excel financial reporting tool or the next option that's on this list. But the built-in reports don't handle that. So you would have to use either the Excel reporting tool or the last option that's there, which is the Vivid Reports. Now, Vivid Reports is a business partner of ours and has been a business partner for the last 4 years now, I believe, maybe 5. And it's been a fantastic business partner. If anyone is a longtime SedonaOffice customer, they know that we have tried to team up with 2 other third-party financial reporting tools over the years. And the problem with them was they were very, very, very expensive. And I mean very expensive. Vivid Reports is an extremely reasonable price product. It is extremely powerful and robust. It has the ability to create expanded delivery options of your financial statements. So if you have different branches or different departments or financial outside people who need to get financial reports, you can build a whole set of reports and then create a distribution, and only those users or those people in the distribution list will only see what they have access to. So it's really, really cool. As well, it has very, very advanced budgeting features. So a lot of our users get away with using the Excel reporting tool. It's very powerful. But for those who really need the advanced functionality, I can't say enough good things about Vivid Reports. Now, on our website, you will find a webinar, a previously recorded webinar, where we actually demonstrated the Vivid Reports. They will also be at the users conference. So it's a great time to sit down with them and talk to them. But it's just fantastic product. So and you could create almost, like I said, any type of layout, whether it's at the branch level, the category level, and really see your reports. The other thing Vivid Reports does, it has complete drill down capabilities. So as you're analyzing your financial statements and you're looking at a GL number, you can literally just click on it and drill down and see all the transactions that made up the details of that report. So again, it's a great, great solution for your financial reporting. And in just a moment, I'm going to go back in and I'm going to show a few things on the Excel reporting tool. Before I do that, I want to talk a little bit about job costing. Job costing is probably one of the most tricky things that our clients have to deal with, especially when it comes down to doing reconciliations of that against the general ledger. So these are the 4 most common job costing strategies that I've seen and worked with our clients over these past years. It's not a right and wrong, and that's what you have to remember. So it's not, is one better than the other, or what's right, what's wrong. It really comes down to what is in your best interest. And this is a discussion you should have with your CPA. There are tax reasons that you might pick one strategy over another. There's business processes, there's reporting. So the first strategy is just actual. And actual job costing means you are recording income and expenses real time as they occur against the job. When an invoice is created, it records the income against it. When an expense is incurred, whether it's labor, materials, or any other expense, it's being recorded against that job. And you see it real time. Again, if you are in mostly residential, small jobs, in and out within a day or two, I would strongly recommend using an actual basis, because you don't have to deal with the reconciliation of WIP. So, and remember, the job costing is all driven off of the job type. So you can have different job types have different costing methods. So if you have a residential division and a commercial division, and you want the residential division to use one costing method and the commercial division to use another, you can do that. Now, the next method is a percentage completion method. And we're seeing more and more companies adopting this, especially systems integrators. A percentage of completion is really using the actual costing methodology. And then at the end of the month, comparing your estimate of what you projected to sell that job for to the actual expenses that have incurred, and determining what your percentage completion is, and then using that to determine, are you over or under invoice for that job within that accounting period, at the end of that accounting period. So if you have not invoiced the customer but you're 50% complete, you might want to do a 50% accrual entry on your income statement and balance sheet to just to recognize 50% of the revenue. If you had built, for some reason, invoiced that job 75%, but you're only 50% complete, you're actually over invoiced, and you might want to do an accrual entry to lower the income that's in place. So, and most companies who do a percentage of completion invoice over under adjustment usually do it in bulk and in total. They don't do it at an individual job basis. So they look at all their jobs, determine what they're either over or under invoiced, and then they actually use make an accrual entry at the end of the month. I think it's a great method for systems integrators, and this is something that I actually personally recommend. Now, another methodology is using WIP. WIP is work in process, and it's actually parking your expenses in a WIP account until such time as you want to recognize them as income or as expense. Typically, that's either when you create income on the account, or it's when you close the job in full. And then some companies on top of the WIP will defer the revenue as well. So what they're really doing is they're taking all the income, all the expenses on the job, whether it's progress invoicing, all the expenses, they're putting it on the balance sheet, and they don't reverse it off of the balance sheet until the job is closed at the end of whatever period that it's closed for is when you're going to recognize all the income and expenses. Now, both with WIP and deferred revenue, you can put strategies in to do accrual entries based upon your work in process as well. But these are typically the 4 costing methods that we see out there the most. If you have any questions, feel free to call us. Now, one of the persons that I'm going to give a plug to right now is Jim Lee. And if anybody who is, especially integrators, if you've worked with him, Jim Lee is with Astute Financial Services, and for the past 8 to 10 years now, it seems as long as I can remember, Jim has really made a business out of working with SedonaOffice customers. And really, one of his expertises is the whole job management and job cost accounting. And he is fantastic at working with companies and setting up their strategies for doing all of their job cost accounting. So if you do have any need for this, I would highly recommend discussing it with Jim Lee, and he's great at just helping companies set all that up and looking at that. Okay.
Michael.
Sure.
If I am currently using WIP, is it easy to just change to actual?
That's a good question. It's not difficult, but you do have to get some consideration into it when you do change. It's not as much for the new jobs going forward. It really has to do with any jobs that are in progress, because the jobs that are in progress might have some WIP, and that WIP needs to be recognized as income over the life of that job. So your jobs in progress are going to be more of the tricky ones you're going to have to work through as you do that. Another thing that you might want to do when you do make the transition is create new job types. So the old job types that were set up using WIP, leave those as place. Don't change the structure on those. Just create new job types going forward. And the nice thing is you can actually use the copy feature to copy the job type to a new job type and then just modify the new one to an actual costing. So I hope that answered that. But if you do have any questions on it, let us know. Anything else right now, Rebecca? Okay. So let's talk a little bit about deferred revenues. Deferred revenues, as you know, are created automatically within SedonaOffice when you post your cycle invoicing. And if the recurring item code is set up to use deferred revenue, instead of it, when the recurring is created, the recurring will actually credit a deferred revenue account, and then it will be recognized as income throughout the period in which the services are, whether it's monthly, quarterly, semi-annually, or annually. Now, this report that I'm showing you is a great report to start getting in the habit of using. This is your deferred revenue summary audit report. And just like you balance your accounts receivable or your accounts payable, get into the habit of balancing your deferred revenue on a monthly basis. And your ending deferred revenue summary on this report should balance to, and then we want it to, balance to your general ledger. This will also balance to your deferred revenue distribution report that will show you all your open deferred revenue as it's spread out over future periods. So make this part of your monthly your monthly close procedures. And what this report's showing you is the beginning balance of your deferred revenue. You're always running this report for a specific accounting period. It will show you any new deferred revenue created within this period, which is typically done through cycle invoicing, although deferred revenue could be coming in through, when you create jobs and you create recurring on job invoices, or if you do miscellaneous. It's also showing you all the posted deferred revenue when you post your deferred revenue, and then it will give you your ending balance. The GL account that it's showing you here is actually the GL account that the income is ultimately going to be posted into. And when you run this report, you could run it either by GL account or by item code to see what that is. Now, recognizing your deferred revenue, when should you do that? I get asked that question quite a bit. Should we do it at the beginning of the month? Should we do it at the end of the month? Should we do it in the middle? Well, the answer is it really doesn't matter. It really comes down to when do you want to look at your financial statements. So you could do it at the beginning of the month, And then you could do it again at the end of the month. So what I recommend, no matter what, is right before you do close your financial your accounting period, make sure you recognize any deferred income. You'll also notice that if you go to close an accounting period, so you go to close, for example, October and open November, if there is any deferred revenue in that October period when you go to close it, it's going to give you a warning message and tell you, hey, wait a minute, you have deferred revenue here. So make sure before you close it, you recognize any deferred income. And again, you could do it in the beginning of the month, so it updates your financial statements then, and then you could do it again at the end of the month, maybe just to pick up any transactions that occurred throughout the month. Make sure you do that, as again, as part of that month-end process, that you are recognizing your deferred revenues. Okay? Okay. So year-end journal entries. Just a few things I want to point out on the year-end journal entries. So as you get into, and assuming you're on a calendar fiscal year, as you get into March, April, May of next year, and you're going to do some year-end journal entries because your CPA says make these as depreciation entries or do this, remember to use the reopen option. So when you open December of 2014, don't just open the accounting period, use the reopen option, and make sure that only the controller has the authority to create journal entries or create any type of transactions using the reopen feature. And again, that's set up in the user security options. As a good habit, date all year-end transactions at the end of the year, December 31st. It makes it easier for you to audit and to find those. If you have to do any accruals, use the reversal option in the journal entry feature. And within there, it's a great feature. So an accrual entry is if you need to create an entry, but you want to reverse it the next period. Now remember, if you're going to use it, both periods have to be open. So if you're doing an accrual entry on December 31st and you want to reverse it on January 1st, you need to make sure both periods are in either an open or a reopen status. And then the last thing is archive a backup of your database at year end. And you could actually mount it right in your SQL Server if you want to. And if you need any help in doing this, you could use the Sandbox utility and just rename that database, or you could contact our support department. But it's just a nice way also to have an archive of your backup of your database as it ended on a fiscal year. And that way, in case of any time you ever had to go back and look back, and sometimes, who knows, maybe it's 2 or 3 years later, and you want to make sure you could see it exactly how it ended, it's just a nice thing to have in your records. So, so before I go into the questions, let me do this. I'm going to come into Excel for a moment. So this spreadsheet that I have open, and you could actually download this right off of our website. This is the GL template, an example of creating your financial statements using our GL, our Excel financial reporting tool. And again, there's a lot of different ways you could set this up, and there's also complete instructions on our website as well. But if you wanted to create your own financial statements, this is a variable page that I've created for this example, where at the end of the period, I would just have to come in and literally change just a few variables within here, and then this would actually then go ahead and drive the financial statements that we're reporting. So let me click on the income statement tab. So this is my income statement tab, and I'm going to make this just a little bit bigger so maybe it's a little easier to read. Let me make this, I'm going to make this 35%. Okay. So you'll notice there's a few things going on here, and I won't do a whole training on this, but right here, if I'm looking at there's my income statement that I'm actually going to present. So in this case, I'm just running a real simple income statement, and this is a year-to-date for the period ending, in this case, December 2007. It's actually done by using what's called a GL masking. So I'm masking my GL numbers that I want to appear here, and I'm using a data selection. And this is just a data selection that's telling us the data selection is really a makeup of your GL structure. It's your branch, your GL number, your branch, your category, your fiscal year, and your accounting period. Right here is my GL data tab. The GL data, this is actually the raw data that is returned from SedonaOffice that we're doing the GL reporting on. And this is all built into the tool, so you don't have to worry about how to create this. You just go in and you build what's called a connection string to the SedonaOffice database, and it returns the data automatically for you. So here's my GL statement. Actually, this is a month-to-date report I see here. But this is giving me all my income. There's my expenses. And again, however I want to lay it out, and I get my net profit. Now, so that's a real simple income statement. So here is just another tab where we expanded it just a little bit. And let me just make this a little bit bigger. Okay. In this example, we're showing both a month-to-date and a year-to-date number. And if I wanted to, I could put in a percentages in here or do anything else like that to see where we're at with anything. Now, I can also do an income statement budget compare. So in this case, what I've done is we have built a budget analysis. And in this case, I'll try to make it a little bit bigger. We've actually done a budget, and then you can see there's a comparison, and then there's a variance tab. Don't get caught up in the data. This is just fictitious data. But you can see once you build a template one time, you can then change it and easily do it. Now, the nice thing is each month when I go in and I want to do my next month's financial statements, all you do is you refresh your data, you change your variables to the period you want to do it, and then you have your financial statement. So literally within 10, 15 minutes each month you could do that. You can use this to create balance sheets. So here's a balance sheet. And again, you can lay this out any way you want. You could use individual accounts or you can consolidate accounts depending on how you want to do it. Here you could do, this is an example where I built my budget. So this is my budget that I built using the same template. You can also get into branch income statements. And a branch income statement will be, looking at the same thing, but now I'm separating it by my different branch codes. So here I'm looking at my branch Ohio and my branch Michigan. As well as you can do category financial statements. So in this case, I actually built different financial statements for my installation department, my service department, my central station, corporate, and then there's my totals. So the answer to that question before, doing that income statement for one category, you can use this tool very easily to do just that, okay? You can also do a rolling monthly income statements. Let's see what else we have in here. So that's another example of that. Like here, doing October, November, December. And you could spread this out over 12 months. So again, any way you want to lay it out, you can do your financial statement. So this is a really nice tool to do it. The Vivid financial statements just takes this and just makes it much, much more powerful and gives you a much nicer, robust delivery system to go with it as well. Okay. So Rebecca, I'm going to turn it back to you now and ask if there's any questions, and then we can wrap things up.
Okay, have a few here. Where do you get the Excel reporting tool?
Okay, the Excel reporting tool is actually made available right on our website. So if you go to the, let me just go over here to the SedonaOffice website, you'll notice under, and I'm sorry, my screen is doing some funny things here because of the GoToWebinar. Sorry about that. But if you go to our website, it's right on our website. You can download it from there from the reference guides, and it's available right there. If you have any questions, just contact our support department, and they can walk you through it. So there's both a sample template that I just showed you, as well as the a whole reporting guide that walks you through how to build the financial statements.
Okay, and the next one is, what is the reversal option to record accruals?
Okay, so what that is, if you're inside of SedonaOffice and we go into a journal entry, okay, so you notice, let's just say I just wanted to do a basic journal entry, and I'm going to pick an account, and it might not be realistic, but I'm going to pick a bank account, and I'm going to call this a month-end adjustment. Okay, and so I want to credit this bank account $500, and then I pick an offset account, and I'm just going to pick another bank account. Now, so that would be a journal entry, and let's say I wanted to do this on 11/30, but I want to reverse this on 12/31. I come over here, I click reversal entry, I say 12/1, not 12/31, and what this will do now, when I file this journal entry, it's going to create this entry exactly as I created it on 11/30. By doing the accrual or the reversal, by checking this on 12/1, it's going to create the mirror image of this, and it will debit this account and credit this account, therefore reversing that entry. So I don't have to create two separate journal entries. I'm creating one journal entry for the whole transaction. So that's how you do that. While I'm in here, another nice option, especially if you have to do journal entries at the end of the month, at the end of the year, I like to do them in Excel first. Make sure they balance, especially if there's a lot of accounts. And there's a feature in here where you can actually paste from Excel. So you can actually create the journal entry. You actually have to create a Excel spreadsheet using the same exact column headers as you see here. You would copy the data in Excel, and then just click this paste button, and this would actually paste that journal entry into the journal entry form for you. Again, it's a really nice way to add a journal entry, and this way you can use Excel to make sure everything's good before you put it in. You can also use the copy this to Excel. So if you do create a journal entry here, but you say, I want to copy this and paste it into Excel, that's what this button does. It just copies all the details, and then I could just put that into Excel later on and paste it in there. So those are two nice features within the journal entry. Okay. Anything else, Rebecca?
Yes. Why would the retroactive AR/AP aging reports by branch not match the branch level balance sheet, or should they?
They should. They should. So the first thing I would do is I would go and verify that does a balance to the AR audit report, and do we have a discrepancy in there? Because the nice thing is you could run that AR audit report for any previous period. So for example, if I go into my report manager here and I pick my general ledger AR audit report, the nice thing is I could run this for any period. So if I wanted to, let's just say I wanted to go back to September of this past year, I could go in here and rerun that report right from here, okay? So that's the first thing I would do, is I would take this report and then take your retroactive aging report and determine, am I in balance or not in balance here? Now, I will tell you the retroactive aging report does do some serious data crunching to go back, because that's a report that has to actually recreate itself. So we have to make sure that it's fresh and no other transactions have impacted that. Sometimes you might have to refresh the data, but theoretically speaking, they should be in balance. And if they're not, then let us know, and we're going to have to do some forensic work with you to determine why it's not in balance.
When you make a journal entry within job costing, does that flow to the GL?
Yes, it does. Yes, it does. That's a live GL entry. So if you are in the job management system, job, and let me just pick any job within here, and if I'm inside this job and I come over here and I click on tools and I do a journal entry, that is a journal entry that is posting to the general ledger. And it is also, the only difference is it's fixed for all the journal entry will be linked to this job automatically because I'm doing it within this job. And as well as you could use the reversal entry from here as well. Now I could do a journal entry from the general ledger from right here and also reference the job if need be as well. So you could do it from either or location. So I hope that answered that.
Okay, two more. If you can't journal to AR, how do you write off bad debt?
Good question. So obviously you need to have a bad debt account. And so if a customer has an open invoice and you're going to write that off, you're going to have to credit that. So you're not going to debit your accounts receivable. You will create a credit memo on the account, and most likely you will go against a bad debt expense. You could go against the original income if you wanted to lower the income that was created for that. But if it's a true bad debt write-off from a previous period that it's uncollectible, you might want to use a bad debt. The other reason why you might not want to, and you might want to use the income account, and again, this is something you should talk to your CPA and make sure that it's okay to do this. I'm not giving CPA and tax advice, but if it's a taxable write-off, meaning you paid the sales tax because you're on accrual basis for sales tax, and you paid the sales tax 2 months ago, now you're writing it off, and you want to credit back for the sales tax you paid because you're lowering your sales, at that point you might want to use the original sales account that was used or the original invoice item so that it will adjust it including the sales tax. Because usually if it's just a bad debt write-off, you're writing off the whole thing and you're not getting that sales tax credit. So again, something to think about and to do that. But when you're writing off receivables, you need to create a credit memo for that.
Are you able to create a recurring monthly journal entry, one that needs to be posted every month?
So the answer is it will not automatically post every month for you, but if you come on and you create a journal entry, you can save that journal entry as a template. And then all you have to do is every month come into here, you would pick a template, which is a previously saved journal entry. You can modify it if need be, and then you can actually, then it will just actually post. So if you have the same journal entry you're going to use month in, month out, just create it and save it as a template. It will not automatically post, but it will at least, you won't have to re-enter it from scratch each month. It's also a great thing to use if you have like a payroll journal entry batch or the same type of journal entry batch in any scenario that you're going to use, more than once, is you could save it over and over. Okay. Another thing is it's a nice feature is if you create a journal entry and you click this option right here, template only. What that will do is when you click save, it won't actually post this as a journal entry. It's only going to do is save it as a template to be created in the future, to be used in the future. Okay, so that's what this template only button does. That's why when you click the template only, it takes away the reversal because you can't reverse a template only. So, okay, so that's a nice feature as well. Okay.
How do you adjust offloaded labor rates from job costing?
Ooh, I wish we could answer that in this time period. That's a good question, and I think it needs a lot more discussion, and we are running out of time, so I'm not trying to cop out and not answer it. Why don't Rebecca capture that is, and we'll follow up offline on that one.
Okay.
So we got time for like one more.
Okay. We have two more, so maybe two.
Okay.
How do I refund a credit memo to a customer?
Okay, so if a customer has an open credit memo, so let's just go over here, and I'm going to go to unapplied cash and credits, and let's just find the customer. So here's a customer right here that has an unapplied credit on account. Okay, so I'll open up that customer. So if I needed to refund, let's say I have this $10,000 credit and I wanted to apply it, I can create a refund check right from here and do a refund check. And what this would do is it will automatically adjust off the credit memo and create a refund check in the accounts payable system as a check to be sent and cut back to the customer. So that's how you would do that for that. Okay?
Last one. If you have a large job, how can you make sure that the parts issued are costed for in the month that you do a progress invoice?
Okay, so that's a good question. Again, that's a long answer to do that. I'm going to try to simplify it the best I can with just the time we have. And really, that would be by using a strategy of using that actual method. Because at least that way, the moment you actually issue that, it's going to go into cost of goods sold. If you're using a WIP method, then it's a little bit trickier because unless you create an invoice, there's no way to remove it from the WIP to the cost of goods sold within that end of that month. But if you're using the actual methodology, anything that you do within that month will be hit the cost of goods sold in that current accounting month. I don't know if that fully answered it, but it might be worth we could talk more about that and your strategy and how you do that. So I want to again thank everyone for joining us today. I hope this was worth your time. And again, we hope to see you next month in San Diego at the Users Conference. And if you're not going to be there, then definitely make plans to see us in January of 2016 at the next Users Conference. Thank you, everyone, and have a great day.